welcome back, accounting boffins. Remember, we're busy analyzing a projected income statement. Okay, so our emphasis here is on our projected income statement. Remember, we're doing this here. So we are busy analyzing a projected income statement. Here's the information that we have. Right, in the additional information, we are told that your rent income increased by 9% on the 1st of October 2020. Okay, now look at the variation in the question. You are given the rental for October already. You are expected to calculate the September rental figure. Notice, in previous questions, you were given the September information, you had to calculate October information. Now, it is totally different. You are given the October information, and you are now expected to calculate the September information. Right, let's do that. Okay, this is what we do. Firstly, we know that the October figure of 10,028 is equal to 109%. Right? Why do we say that? Because obviously it has the increase built into it already. Therefore, this 10,028 is equal to 109%. What are you calculating? You want to calculate the rental prior to the increase, before the increase. So obviously, before your increase, your rental was 100, and therefore that serves as your unknown. Watch my calculation, cross multiply, you take 10,028 times 100 divided by your 109. Let's do that. So it's 10,028 times 100 divided by 109, and you're going to get a figure of 9,200. So what is the 9,200? Your 9,200 is your 9,200 will be your rental for September. So in other words, if we have to complete this table, you can see that that is your 9,200, which was your increase, it was your rental prior to the increase. If you want to check on it, certainly you can do that as well. And that all that you do is you take 9,200 times the 9%. Watch, you're going to get a figure of 828. Add that with your 9,200, and there we go. 10,028 is the figure that you're getting as your increased in your rental. So in this particular instance, you have to use the increased rental to work out the rental prior to the increase. Okay, next one. Here goes. What do we have here now? We're expected to calculate. We are told with regards to our credit sales comprise 80% of total sales. First proviso. Sales are expected to increase by 10% per month and then by 12% during November 2020. Okay, what are we expected to calculate? Let's do our calculation here. Calculate the total credit sales expected in November 2020. So that's our calculation. Watch, this is what we do. You start off by looking at your October sale. Your October sale is 198,000. So you take your 198,000 times 112. Why is it 112? Because the increase is 12%. Let's do that. Okay, so you start off with your 198,000, right, times the 12%, which is your increase amount, and you get a figure of that plus the 198,000 to give you a figure of 221,760. Remember, that's just your total increase in your sales. Now, because credit sales amounts to 80% of that figure. What we now do is we multiply that by 80%, watch, and that will then give me my figure of 177,408, 177,408. That becomes your expected credit sales for November. You could also work with your September actual figures, right? And if you're doing that, then what do? Watch, it's 195,000 times the 10% increase, and then a 12% increase, and then 80% of that figure. So in other words, if this is what we're going to do here, watch what we're going to do. It's 195,000 plus your, let's do this again, times your 10%, okay? And that will give you a figure of 19,500 plus 195,000. This will then give you a figure of 214,500, right? Now we say 214,500 times your 12% is 25740. If you add that figure to your original figure, which was plus the 19,500 plus the 195,000, okay? And that gives you that figure times 80%. Here we go. We get a figure of 192,192. So in other words, if you used your September figures, that means you have to go back 2 months, right? Then, what was the proviso? Our proviso was, if we look at the proviso, they told us that sales was going to increase by 10% and then by 12%. So therefore, there's your 10% increase from September to October, and from October to November was a 12% increase. So in other words, if you used, or not if you used, we actually used the October figure here, and you can see it only resulted in the 12% increase to give us our 177,408. But if you use September figures, you have to first calculate the 10% increase, and then the 12% increase, and then the 80% to give you your total expected figure in terms of your credit sales. Now remember, why are we multiplying by 80%? Because it is expected that credit sales will be 80% of your total sales. So, once again, look at the requirement of the question. The question said, calculate your projected credit sale for November. And based on that, this is the calculation that we have to do. Okay, next one. You are required to calculate the cost price of the new vehicle that was purchased in September 2020. Let's look at the information that we have. We are told a delivery vehicle was purchased on the 1st of September 2020. Vehicles are depreciated by 15% per annum on cost. The accountant did not take this into account when preparing the projected income statement for September 2020. Okay? Let's see what we have here. You have your September budgeted figure of 6,200 and the actual figure was 9,000. So clearly there's a discrepancy, right? Or like we alluded to in previous lessons, we said there's a variance, there's a difference between your actual and your budgeted. Okay, now watch the procedure. This is what we do. Firstly, take your 9,000 minus the 6,200. The difference between the two will give you a figure of 2,800, right? So the difference in depreciation amounts to 2,800, okay? Multiply that by 12, okay? And then calculate 15% of that figure. Why? Because our rate of depreciation was 15% per annum on cost. Okay, so let's do that. Here we go. Firstly, we said take your 9,000 minus your 6,200 will give you a figure of 2,800. Multiply that by 12 will give you a figure of 33,600. Now, watch this here. Your 33,600 is equal to the 15%, which is your depreciation. You want to know what was the figure on which it was calculated. So here we go. 33,600 cross multiply times 100 divided by 15. Can you see? Let's do that calculation for you. It is 33,600 times 100 divided by 15, and that will give you a figure of 224,000. Now, what is the 224,000? The 224,000 will be the value of the new asset that was purchased, or the new vehicle that was purchased in September. And how did we come about finding out this? Because the depreciation figures that we budgeted for and what it actually was two different figures. As a result of that, we went back using the depreciation calculation. We were able to calculate the value of the new asset that was purchased. So clearly you can see when we did our actual depreciation calculation, it was done on all the vehicles, including the new vehicle. Right, so what do we see here? Once again, just to recap on this one here, we're using our depreciation as our calculation. We took our actual minus the budgeted. It gave us a difference. We took that difference and multiplied it by 12. Reason, that was only for 1 month. That's why we're multiplying it by 12 to give us the annual figure, right? Because your depreciation is 15% per annum, and that's important. So times your 15% will give you the actual figure that you calculated here, the 33,600, was your depreciation at 15% per annum. You then went back to calculate the original cost price, and that gave you a figure of 224,000 Rand. Okay, so this is how you analyze a projected income statement. This is how you go about doing your calculations based on information that you have. All right? Okay, so when you come back to us, we're going to do more questions regarding analyzing a projected income statement. Let's take a quick break, let's refresh, and see you soon after the break.